Anglo American has raised 9.6 billion rand from its accelerated book build offering of shares in Anglo American Platinum. The diversified miner sold 17.5 million Amplat's shares. This represents about 6.6% of the group's total issued ordinary share capital. The move is part of Anglo's strategy to simplify its portfolio. The firm says the demerger of Amplat's is on track for 2025, and so it won't execute a further market sell-down of its holding ahead of that. Hyprop Investments has continued to grow tenants' turnover and trading density. Releasing an update for the 4 months ended October, the group cited management's ongoing repositioning initiatives and leasing strategies as well as better consumer sentiment as reasons for the growth. The Specialist Retail Property Fund also announced that it would review the group's dividend policy and payout ratio, and any changes to that will be communicated when it releases half-year results in March. Nampak is eyeing a return to profitability. The packaging group expects to report annual headline earnings per share from continuing operations of around 31 rand. This compares to a headline loss of 390 rand a year ago. That's as the firm's turnaround plan starts to bear fruit. Nampak will open its books on the 2nd of December. And as part of a crackdown on fraudulent and corrupt activities, the Road Accident Fund has blocked the disbursement of 65 million rand in claims over the past 3 financial years. RAF CEO Collins Letswalo says fraud negatively affects service delivery to road crash victims and their families. He added that the fund's fraud detection strategy aims to enhance the operational plan of ensuring the RAF reduces the time it takes to pay legitimate claims to claimants genuinely affected by road crashes. In international news, after years of investor pressure to abandon its presence in China's Xinjiang region, where rights groups have documented abuses including mass forced labor in detention camps, the automaker Volkswagen has confirmed it will exit its controversial plan in the region, or plant rather. There's more detail in this package report.
Volkswagen will exit its controversial plant in China's Xinjiang region. It comes after years of investor pressure to abandon its presence there. Rights groups have documented abuses, including mass forced labor in detention camps. Beijing denies any such abuses. VW and its Chinese partner agreed to sell the asset to a Shanghai government-owned buyer. The transaction value of the deal was not revealed. The significance of the plant, which used to assemble Volkswagen Santana vehicle, has dwindled in recent years. The German carmaker cut jobs at the plant, leaving about 200 employees to conduct final quality checks and hand over vehicles to dealers in the region. VW has denied reports that it kept the plant open as a condition from Beijing to keep producing across China. The decision to free itself from the plant comes as VW is battling to boost flagging sales in China, its biggest market, amid intense competition and sluggish demand. Europe's car companies also have to contend with the impact of a potential trade war between Beijing and the European Union. That's after the EU imposed anti-subsidy import tariffs on China-made electric vehicles.
And EasyJet says it expects its capacity to increase by 3% in fiscal 2025 after reporting a smaller than expected annual operating profit due to disruptions from the ongoing conflict in the Middle East. Here's more detail in this report.
EasyJet surprised markets Wednesday with a smaller than expected annual operating profit. The budget airline reported profit of $750.5 million for the year ended September 30th, below analyst forecasts. It blamed disruptions from the ongoing conflict in the Middle East. However, the number was still 25% higher than a year earlier. CEO Johan Lundgren called it a significant step towards the carrier's goal of generating over £1 billion, or $1.26 billion, in annual profit before tax. EasyJet also gave a positive outlook for next year. The airline said it expects capacity to rise by 3% in fiscal 2025. It sees strong demand continuing and more interest in its lucrative package holiday business. The airline also projects holiday customers to grow by about a quarter from last year for the current fiscal year ending September 2025. Analysts believe lower oil prices should help EasyJet's books next year too. EasyJet shares flew up 3.4% soon after the market opened.